the leaders of tomorrow, India's largest platform for entrepreneurs. We have 10 seasons where we've continued to empower you, the small business owner, and recognize excellence. I'm Sunanda Jayaseelan. On the show tonight, we are decoding all the announcements that we heard from the RBI governor late last week and talking about what that means for the rest of 2022, what it means for small businesses like yourself, and what you should be watching for in terms of some of the global cues. Let me quickly introduce our guest tonight. Brinda Jagirdar, Senior Economist. Vivek Kumar, Economist, QuantEco Research. Ma'am, Vivek, thank you so much for taking the time to join us here on this very special discussion talking about the monetary policy and budget plus. We've heard these two key announcements from the government and from the central bank. What next? And that's the question. And helping our viewers understand what next is what we're going to do in this very special panel discussion with two of India's sharpest minds when it comes to what's happening as far as the macro policy is concerned. Very briefly, everyone has seen the headlines from the RBI keeping the repo and the reverse repo unchanged. Accommodative stance is going to continue being maintained. But we are, of course, talking in the backdrop of everything that's happening globally, particularly the Fed action. Before I come to the Fed, very quickly, I want to start with the big question on everyone's mind and just read out the projection as far as inflation is concerned. Retail inflation rising to a 5-month high of 5.59% in December from 4.91% in November. This is for the benefit of our viewers, mainly because of an uptick in food prices. So my question to sort of set the ball rolling, first and foremost, could you give us your takeaways? Were you expecting that it would be status quo as far as the headline on monetary policy is concerned? One. And two, your reading really of inflation and where it stands right now. I'd like to come to you first, Brinda.
Okay. The first thing that comes to my mind is that the credit policy has provided a perfect foil to the budget. So I think they're both moving in sync now with a focus on growth. So what the credit policy has done is that it has focused on continuity and growth, just like the same things which the budget has done. So growth still continues to be center stage for the RBI and the government. And I think for now, inflation worries have been pushed back. They've not gone away. They've just been pushed back. We just need to hear and see what the Fed is doing. Because where inflation is concerned, as you rightly said, in December it was 5.9%, but it is still within the comfort zone of RBI. And I think the biggest surprise for me was the RBI announcing that next year's inflation would be a 4.5%. I thought it would be 5% plus. So that there, I must say, it came as a big surprise. But really, what has happened is that in the US, they have about say 1-2% inflation, maybe 2.5-3 maximum. But this time they've reached 6%, 7%, and they seem to have they don't want to lose control. They don't want to let the genie out of the bottle and go through what they did about 2 decades ago when Paul Volcker had to step in, and then it was really very difficult. So they don't want to go down that path at all. So for now, they are focusing very much on inflation. Where India is concerned, inflation definitely has risen. Food inflation has softened. And we have a lot of positives also. So from an inflation point of view, I think for now, we can rest a little assured and we can focus on growth.
Would you agree, Vivek? Were you expecting perhaps different key takeaways from the RBI, and also your views on the inflation figures?
Well, thanks, Sunita, for having me here. We would broadly concur with what Brinda ma'am just said. Having said that, we were a little bit pleasantly surprised because, like most of the market participants, we were also expecting a 20 basis point upward adjustment in the reverse repo rate. We would not call it a hike yet because how we see the current policy corridor is it's nothing but a manifestation of emergency level monetary accommodation, which started in the months of April and May 2020. And since then, it has been kept like that. So the normal rate of policy corridor is about 25 basis points. That's the spread between the repo and the reverse repo rate. And during the emergency time, it broadened to 65. Now, the current environment, we feel that the economy is out of ICU. Okay. While yes, it does need support, there's no denying there's still a lot of support which is required. But the ICU level treatment need not be there. Now, looking at the other part of the question, what about inflation? The central bank projects it at 4.5% for FY23. We, like Brinda ma'am said, we are slightly surprised by the extent of comfort that they're drawing. Reason being, commodity prices are at almost at their multi-level highs, multi-year high. For example, crude oil prices almost touching $90. Most of the other commodity pricing, barring precious metal prices, are pretty heated up in the recent months. So that is all going to reflect in your CPI inflation sooner or later. Maybe post elections, you'll start seeing a lot of pass-through happen. And the other side of the coin is that we also expect economic activity to normalize as you move forward. Okay. And vaccines also helping. Your pent-up demand will come back into the system. So that will keep your inflation more or less at elevated levels. So if you can break it down into three parts: food inflation, fuel inflation, and core inflation.
So, we're talking about inflation, of course, and what we're expecting will happen domestically in India. But let me look at what's happening across the globe, or at least what is expected to happen across the globe. The Federal Reserve indicating that they will start raising interest rates as early as March 2022, early as March of this year. One, how many rate hikes do you perhaps see? And that will have some bearing, of course, on what's happening here in India. Open to both of you. Very briefly, Vivek, if I can come to you first, then I'll come to Ms. Jagirdar.
Well, we would expect about 4 rounds of rate hike. So that's 25 into 400 basis point of rate hike that the Fed could potentially deliver. There's a slight amount of uncertainty with respect to whether the first rate hike is going to be a 25 basis point or whether it's going to be a 50 basis point. We think a gradual approach is better. So instead of doing a 50, 25, and a 25 during the course of the year, of 4 rounds of 25 basis points would be better. That's what is our expectation now. In terms of what we think RBI could possibly do, well, the RBI definitely has to first react on the reverse repo front. Only then it can start looking at the repo rate. And we think the reverse repo rate will be hiked in 2 succession, 20 basis point each. And with that, the reverse repo rate will go to 3.75%. So hopefully between April and June, the reverse repo rate will get normalized. Subsequently, the RBI would start looking at the repo rate because that is where the main action is in store. Sure. And for the year as a whole, we would expect about 2 rounds of rate hike on the repo front, taking it to 4.5% by the end of March 2023.
Sure. But the same question being posed to you, Ms. Jagirdar, but also I want to talk about what this is then going to mean for emerging market assets like India, particularly India, if we are to see a continued rate hike policy on the part of the Federal Reserve.
No, globally, there's no running away from rate hike. It's only a question of when. So I think when the Fed will start increasing by March, as they've indicated, but we may not be in such a hurry to do so. I think there's going to be a lag between what the Fed does and what the RBI will do. But I agree with what Vivek says, that there would be 4 rate hikes of 25 basis points each because they want to do it gradually. But first of all, they would change the stance. They would caution the market, would prepare the market. So I suppose in the next policy, perhaps there could be, or maybe even later in the year, the market, the RBI will signal a change in stance. They will after that they will start to increase a reverse repo rate, and that would be they would reduce the corridor, bring it back to 25 basis points, which was there earlier. Having done this, then they would be more comfortable in raising the rates, but I don't think they're going to be in any great hurry to do so. They will do it very gradually. And what impact is this going to have on us? See, I think initially there could be a little bit of some outflow. You could see some outflow, but I don't think this is going to be a major issue at all because growth is here in India. It's the fastest growing economy in the world. And if we are having growth of 7, 8, 9%, then where will the FIs and FPIs, where will they get this kind of a return? So where capital is concerned, I think there could be a short-term, maybe a little hiccup, but capital inflow is not going to stop.
I'm going to slip into a short break on that note. Back in just a moment. Welcome back. You're with us here on Leaders of Tomorrow. Tonight, we are talking the monetary policy and the way forward, what it means for India's small businesses like yourself, and what are some of the global cues that you should be watching are looking like right now. What will then this mean for India's small businesses in an environment and in a situation where some relief as far as the NPA figures that we're seeing, particularly for SMEs and MSMEs. But going forward, will the liquidity situation in the country perhaps be as favorable for India's small businesses? What should small businesses really be gearing up for is what I'm trying to understand, given all of these macro cues.
The small businesses have really gone through a very, very tough time, and it's really time to focus on them very, very closely now. But it's not just liquidity, because liquidity was available even earlier, but the small businesses were not running to grab debt, increase the debt, because the businesses were closing down, the people were going back. So I think it's more equity support that they would look for, working capital support they would look for, rather than accumulating debt. The government's by extending the emergency linked credit guarantee scheme, that is a big help for the MSMEs. And of course, even now to increase the liquidity, the tap liquidity of, they've increased that also on tap liquidity. So that is one. And then there is the cap on e-rupee prepaid cards, that again is going to help the MSMEs, and trades receivables. So that again will help the MSMEs. So there are a lot of measures from the finance side which was aimed at helping the MSMEs. But at the same time, we need to see how they can link in, or how they can join up with the big industry, large industry, because they are the suppliers. And it is only with this cycle, when the gears mesh, that's when the growth will really take off. So at the PLI scheme is giving a big push to the large industry and also some of the small and medium industries. So this kind of schemes will definitely help the MSMEs, but I think they really need some more hand-holding for some time.
Okay, and what should that hand-holding look like? Brinda has detailed some of the measures that we've seen on the part of the central government recently, Vivek. What more perhaps do you think this sort of hand-holding needs to continue for some more time? And also if you can break it up between manufacturing and services, because manufacturing, you've heard the announcement on PLI, then there's been more of an impetus now on PLI in the budget. The services sectors, the contact sectors, your travel, tourism, hospitality, and your smaller businesses, like your beauty parlors, etc., they continue seeing the worst really of now the third wave, and perhaps any sort of trickle-down effect that we could see happening from what's happening globally. What should really be that kind of support which is provided to these sectors?
So at the risk of sounding philosophical, Sunanda, I would say that time is a big healer here. So the policy support needs to continue. In fact, it has been continuing. If you look across the fiscal and the monetary divide, the policy support is continuing. And all those support measures which were about to get replaced or probably end by the end of March 2022 have now got extended. Some by a measure of 3 months, some by a measure of 12 months, etc. So that support continues. So that is a big relief. The other bit is the growth orientation of both fiscal and monetary policy. The fiscal is completely all out in terms of supporting growth, investment-led growth, high-quality growth, whatever you call it. And the quality of spending is also something which is improving. In fact, we've never seen that kind of quality of spending in the last 2 decades from the central government. So that is a big help. As far as monetary policy is concerned, the continuation again is something which is coming out as a big theme. RBI continues to support growth despite there is some discomfort on inflation. And the real interest rates in India have been in the negative territory for quite some time now. In fact, if you take a forward-looking assessment, even in FY23, even if you consider 4.5% CPI estimate from RBI as something which would play out, even then the interest rates would continue to remain, the monetary policy rates would continue to remain in the negative territory. So real interest rates are negative, they will continue to support growth.
We're seeing, despite all the news that we're hearing in terms of the global economy, unemployment, etc., what perhaps is a great indication of the strength really of the domestic economy is the slew of IPOs. We've seen really big ticket ones. We're going to continue seeing more. Air India, finally there's been movement on that. LIC, there's finally been movement on that. Those conversations have been going on for a while. So just in terms of the strength of the Indian economy, what would you say the indicators right now are pointing to? First to you, Brinda, and then I'll continue.
The last few years have really helped the corporates to deleverage, clean up the balance sheet, and many corporates have become debt free also. So they are now ready to lend. And similarly with the banks, the twin balance sheet problem that we used to have a few years ago, with the banks also facing a crunch and the corporates being burdened with huge debts. So that is behind us now. The banks' balance sheets have also been cleaned up, and banks have also raised capital in this period of pandemic. Banks have raised capital, so they have very good, excellent liquidity. So banks are in a position to lend, and as we have seen the credit numbers, credit is also picking up. Where corporates are concerned, yes, they are now ready to really go ahead and embark on expansion. So we are seeing the slew of IPOs, which is a good thing. The markets are very confident about the economy and the prospects. So I think, and the people are also, there is savings in the economy have gone up. And household savings, households invest in the markets also. So household savings are there, the economy is doing well, the corporates are doing well. And so I think IPOs will be very well received. And this is one way of raising funds and channeling the savings and available household savings into the productive sectors in the economy.
Vivek?
So yes, it is a manifestation of what the future probably holds. So there is optimism with respect to the medium-term prospects on India's growth. So 7 to 8% you could possibly assume as an anchor for medium-term expectation as far as GDP growth is concerned. So that seems like a very reasonable estimate. The other bit which possibly also explains why there has been so much of excitement is, one is the steady state of reforms which the government has been doing. So it's not just the expectation of medium-term growth. I guess even during the difficult times of the pandemic, the government kept on emphasizing supply-side reform. So we probably stood out in terms of our stimulus measure, Sunanda, because most of the other countries, they went heavy in terms of supporting demand, whereas India stood out because India, to a large extent, also relied upon supply-side reforms. And these reforms, from a medium-term perspective, they do nothing but enhance the potential of the economy. So if earlier, pre-COVID, there were slight murmurs of India's GDP growth potential falling to as low as 6% or 6.5%. Some of these reforms, the PLI scheme, the public sector disinvestment program, some of these programs, from a medium-term perspective, they would uphold India's long-term growth potential. So the equity markets being forward-looking, they would want to jump onto this bandwagon and in cash as much as possible. The other bit is the savings angle, which Brinda ma'am brought. That is also a very relevant aspect from a near-term perspective. Now, having said that, we also need to take into account the fuller picture or the complete picture here. So at one end, you have equities doing exceptionally well. Also, there is a little bit of global liquidity support, which now is slowly getting scaled back. On the other hand, the debt raising by corporates have actually seen a moderation. So net, if you put them together, the equity side and the debt side, the total resources raised by the corporate sector has actually gone down vis-a-vis what it was last year. So there has been a little bit of deceleration. Yes, one leg is performing extremely well, which is the equity side, whereas the debt side has not done so well.
Sure.
So net the picture is somewhat balanced. And the other aspect is the credit side, where banks have now, at least appears that the credit risk appetite has started to improve from getting stuck in the 6.5% credit growth range. Now the credit growth range has moved to 8 to 9%. And if you look at the credit rating environment, that probably is the best in the last 8-9 years. So credit upgrades are outpacing credit downgrades. So that also possibly helps you to explain why banks have now started to reconsider their credit risk appetite. And slowly, gradually, the credit environment is improving.
I do want to talk about the projection as far as GDP is concerned. 7.8% GDP projection, growth projection for FY23, retaining RBI retaining the growth projection for the current financial year at 9.2%. And also, I want to read out a comment from the RBI governor saying India will grow at the fastest pace in the world. India is charting a different course of recovery as we speak. In the mid to short term, India as an investment destination, India on the part of growth. How are you really viewing things?
Yes, this time it's about 9.2%. Anything between 9 to 9.5, I think, would be something which we can achieve. And next year onwards, it would be more normalized to 7 to 8% growth. If we see 7 to 8% growth consistently for the next 5-6 years, then that's going to make a huge difference to our growth. So I think we are very well poised for growth. I have absolutely no doubt that we can reach a $5 trillion economy. Imagine it took us 60 years to reach after independence to become a $1 trillion economy. And look at the way it has doubled after that. In the next 6 years, it became 2 trillion. And if the COVID wasn't there, we would have been 3 trillion and then marching towards 4 trillion. Given the big push that we are seeing in the budget and the support from the RBI, I think we will be able to achieve this $5 trillion economy goal that we have set for ourselves. And I have no doubt that we have very bright prospects in the midterm and the long term too.
All right. Brinda Jagirdar, Vivek, thank you so much for taking the time to join us here on this panel.
Thank you so much.
Thank you.
Completely out of time on this episode. If you have any feedback, our contact details on your screens as we speak. Thanks for watching. Have a good night.